There's a myth out there, a very common myth, that alternatives are always better performing. And that's not true. They produce a better portfolio.
Demystifying alternative investments. Jane Buchan on Consuelo Mack WealthTRACK.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Miller Value Partners, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTRACK. I'm Consuelo Mack. One of the hottest investment topics today is alternative investments. They are either being lauded as the best new investment for individual retirement plans or vilified as an ill-begotten scheme to generate profits for Wall Street. Which is it? Or does the truth lie somewhere in between? I am delighted to welcome a new guest to WealthTRACK who is an expert in alternative investments as an industry leader, manager, and investor. She is Jane Buchan, chair of the Standards Board for Alternative Investments, or SBAI. As described by the organization itself, SBAI is an active alliance of over 150 alternative investment managers and over 100 institutional investors, dedicated to advancing responsible practice, partnership, and knowledge. The membership represents about $11 trillion in assets globally. Buchan is also CEO of Martlet Asset Management, a family office which she founded in 2018. She also sits on several university endowment and foundation investment committees. Prior to Martlet, Buchan co-founded and led Pacific Alternative Asset Management Company for 18 years. PAMCO is a fund of hedge funds focused on institutional investors. Under her leadership, first as CEO of PAMCO and then co-CEO of PAMCO Prisma, the firm's assets grew to $32 billion, placing it third globally in the fund of hedge fund space by the time of her retirement in 2018. I began our conversation by asking Buchan to define alternative investments. What does that term cover?
When people use the word alternative, it's very fluid. But in general, what I would say is it's non-traditional stock and bond investing. So for example, when you think of traditional stock and bond investing, I think of buying the market and holding it. Maybe there's trading involved. And the same thing with bonds. And so alternatives requires that whole universe outside of that.
So you are the chair, fairly newly appointed chair of the Standards Board of Alternative Investments, SBAI, a very impressive title. The SBAI covers, as I said in my introduction to you, $11 trillion in assets. So it's a big deal. What are the alternative investments that you are covering?
So at the SBAI, we were founded in the liquid alternatives, but there's always been a little bit of illiquid alternatives. So some of the things like private equity on the side and private credit and other things. We cover almost all of the alternative space.
What are liquid alternatives?
So liquid alternatives would be things that involve trading. So for example, they could be buying a portfolio of stocks long, but also having a short position on the other side. And there are many funds that do that. You can also think about hedge funds. You can also think about, some sorts of private credits. You may have heard words such as leveraged loans. There's a whole bunch of things where typically liquid means that you can price the portfolio plus or minus every day, at least every week.
So that is not the case for what is very much in the news today, which are private equity funds and venture capital funds. You mentioned private debt.
Private debt. So
private credit. Let's go down the list.
The way I like to think about private equity is that our equity markets became very big coming out of World War II. And in fact, there was an index developed, which was the Wilshire 5000, and people wanted to be involved in the Wilshire 5000. There were about 7,000 companies who were vying for the 5,000 positions. Well, today, there's only 3,800 public companies in the United States. So what's happened over the past 20, 30 years is there's been a move away from the public markets where you have stocks that trade and anyone can buy any interest, to instead get a group together often represented by managers, and to that way own the companies. And because you need to own the whole company, they often involve more debt than in a traditional public company. But it's the same idea. They're growing and building companies, but they're holding it through private hands rather than public hands.
So that's private equity. And that is an industry that is growing by leaps and bounds. There's a lot of money going into private equity, and a lot of companies that would have gone public have chosen to stay private.
It costs a lot to be a public company. You have a lot of shareholder issues as opposed to privately negotiating them. And so that's why a lot of companies have postponed. In addition, when you couple it with the tech boom, which has been going on, these companies grow so fast. They come up with a new area, and a lot of them are category killers. You know, you don't need 10 web browsers. So if you get a great company and you have a great company, it grows very big, very fast, and you don't need a lot of capital. So there's no reason to be a public company.
That's from the company's perspective. From an investor's perspective, something pretty significant has happened recently is that President Trump issued an executive order which basically opened the door to asset managers to include alternative investments such as private equity companies in 401ks, in retirement plans. How big a deal is that?
I think it's a very big deal. And the way I look at it is I come from the institutional world. I'm an investor. And in the institutional world, we have still the big defined benefit plans. And if you look at the asset allocations in these plans, they involve a lot of alternatives. It's very rare to see a big pension plan with less than a third in alternatives when you add up all the different types of alternatives. And so these are being managed by professionals who are paid on building long-term wealth. They have to pay retirement benefits over a long time. So they're looking for very diversified portfolios that have more stability than just being in the equity market, and they understand the power of compounding. And I know that's a term that many of your viewers are very familiar with,
Sure.
where a small amount compounded over a long time can make a very, very large difference. But then as we've changed the landscape for retirement for us, you've gone from not having the pension anymore, you have to have a 401k.
Right.
Well, suddenly you've been shut out from a lot of the same sort of investment options that were available under the defined benefit plan. In principle, I am very for opening up the world so people can achieve the same sorts of returns. And if you look over time, there tends to be an underperformance in the 401k market compared to the defined benefit market. And I think a lot of it has to do with limitations on the types of investments that historically have been permitted in the 401k market.
So one of the arguments or the caveats that are raised about opening the retirement plans for individuals to the, like, let's say private equity, that's what we're talking about right now, is that the best private equity performance might be behind us because it was early years, kind of starting from a base of zero 40 or 50 years ago, and that with the explosion of assets, money going into private equity, that there's a lot of money chasing much fewer quality deals. What is your assessment of that argument?
First off, it's very hard to time things. It's very easy to look afterwards and say something was a bubble, but I've learned over many long years that people tend to, on average, overestimate their ability to time things. So that's important. The second thing to look at is the public markets and the private equity markets are not the same markets. There are industries such as tech that are very represented in the private equity space, not so much in the public equity space. You have NVIDIA, you have some very large companies, but there's a lot of the smaller, newer companies that have remained private, so you're not going to get exposure to that. There isn't a way to get exposure, a good way to get exposure to that through the public markets. So you are making some sector choices, you're making some differential choices. I think you want an investment program that's very diversified, that will withstand all sorts of different types of moves in the underlying economy.
Another argument is that the institutions, that a lot of the private equity deals that have been done, let's say in the last 10 years or so, that they're having a hard time. Number one, they're not going public, so the initial investors aren't getting their money out. And so that Wall Street instead, or the private equity industry, is saying, we've got a new market, we can basically unload this stuff on the retail investor. Is there a risk that it's, bad deals are being unloaded on retail investors because institutions want out and there's no other place to unload them?
One of the things that's very different in alternatives, and typically in a lot of the alternative structures, is there tends to be more incentive compensation, the financial market equivalent of bonuses. And so people tend to behave slightly differently. So what you tend to see is there's a little more alignment of interest, from my view, in terms of returns, natural alignment of interest. You produce better returns, you get more bonus, more incentive comp, and so you do better. And so, yes, you can argue that a manager may have made a bad investment, and every private equity manager, as well as every traditional manager, has always made bad investments, mistakes at times, but overall, they tend to do pretty well. And so there's an alignment of interest. It's not like they're taking a current portfolio now and trying to dump those holdings on unsuspecting people. That manager has a fiduciary responsibility to that fund, and more importantly, they're going to make more money if the returns are good.
But Jane, you are a professional investor. You started and ran PAMCO, which became a very large and successful fund of hedge funds firm. So you know what you're doing. Alternative investments until recently have been relegated to institutions, sophisticated investors like yourself, because of the problems with kind of lack of transparency of what was in them, lack of liquidity, high fees, and also just these long holding periods, and that only a sophisticated investor could really understand what they were buying if they did in fact understand. So have none of those caveats have gone away, right? I mean, we still have the same issues. What overcomes those issues so that they are appropriate now for individuals' retirement accounts?
I think a little bit of detail would help provide a lot of the explanation. So when we established the concept of building mutual funds, for example, that came out of the stock market crash of the 1929. And so those rules were written in the 30s. And those rules made a lot of sense for the way people invested in the 30s. You're looking almost 100 years later, and those rules have changed very, very little until recently about how you invest, how you structure investments for the public consumption. But meanwhile, the whole economy shifted tremendously. If you think about what the world looks like today, we're much more of a knowledge economy. Companies grow big, there's globalization. And one of the big things that I think people miss in the globalization is in the old days, when I started in this industry almost 40 years ago, I could get good diversification by holding stocks and bonds. And if I wanted to be really aggressive in those terms, I could go and buy international stocks and bonds. Because of globalization, you don't see that anymore. For example, these markets tend to move together. 2008 affected everybody. 1998 affected everybody. And so we're not getting the diversification. So now it means we have to go further to look for those diversifications. Plus, as I said, people are deciding at the end of the day, there are these other ways of investing and holding companies, which have always been around, but they weren't utilized. For example, you had private holdings of companies. You had companies, but you had conglomerates. They bought companies and cleaned them up. No longer we have conglomerates. We tend to have more single idea companies, and instead we have private equity. So I think what this is this is a long delayed catch up of trying to reflect how can we open opportunities prudently to the general population. And they have to understand things. You have to put right guardrails in. I mean, there's a bunch of requirements that need to, it's not just, okay, Wild West, let's get rid of all the rules. But I do think after 100 years, things need to be updated a bit.
That makes sense. That is a very good argument. What about regulation?
I think regulation is really important, but I think one of the things, and this is one of my big concerns right now, is I ran a global investment organization. We had clients from around the globe, and we invested globally. One of the big issues today is that regulators regulate locally. So for example, our S&P 500 futures, they trade around the globe in all sorts of different markets. So how do you coordinate regulation that makes more sense?
Is it possible, when you're thinking about private equity, it's companies. So why would they not be subject to the same, vagaries and judgments and everything else of the public markets? I mean, the only reason that they're not is because they're not traded every day, and they're not marked to market every day. But in reality, let's say there's a market crash in 5 years, and that's the time when supposedly the private equity firm is supposed to return its cash to investors. I mean, aren't they subject to the same environment that any publicly traded company is, except they're just not traded every day?
You're right in the long term, but it really changes the day to day. So for example, you are now CEO of a very large company. Your company is public. What happens if you suddenly turn into a meme stock, or you get an analyst who issues a report that doesn't make a lot of sense? Suddenly your stock price is going everywhere. The private equity CEO does not have to worry about that. But you're right, in order to get the valuation, if you're a public company and I want to get my money back out, I'm an investor, I go and just sell the stock. I can't do that in private equity. The manager has to sell the company. And it's like selling a house. You have to find the right buyer at the right time. Some days you can sell your house, and in certain markets you can sell your house, in an afternoon. There are other times you might have to cut the price and you have to wait a couple of months. So that is a very big difference, and people need to understand that. It's the liquidity of like owning a home.
Let's talk about some of the other, alternative assets that are available. How do hedge funds differ from private equity?
They have some illiquid assets, but the preponderance of their assets for most hedge funds are very liquid. What makes them alternative are two things. They trade in certain instruments such as convertible bonds and other issues that you don't really see, leveraged loans. You don't see that often in big mutual funds. And so they access some of the specialty markets. But the big thing that hedge funds do is they tend to hedge. They're not going to produce as much returns. That's why they're called hedge funds. They're not going to produce as much returns as a long-only investor, but the returns are probably going to be more stable. I think what people forget is that one of the really important things about trading is it's setting the market value. And if I am coming and trying to, let's say I am starting a company and I don't know if I want to get involved in private equity or go IPO, it's important to me that the capital markets reflect my value. And that's why it's important that not only do we have the ability to go long, but we can also go short.
Private credit.
So this has been the really interesting one, the very interesting piece, is that historically, for the past 90 of our last 100 years, when you are a company, and particularly a mid-sized company, not a very large company, or you're a company that you want to have a fair amount of leverage, you would go to a bank. But post-2008, we made a lot of rules on banks because the banks were evil, or the banks caused the crash.
No, I mean,
that's what people thought about them.
Exactly.
And then so what they did is they made a lot of very strict reporting rules for banks. So banks, following the rules, because they're bankers and they're very rule-abiding, said, we can no longer make these loans. Well, but the demand for those types of loans didn't disappear. It wasn't like an entrepreneur would come over and say, okay, they can't loan for me to build this new division or for me to buy this new entity. Darn, I'm just going to go home because the bank won't loan it to me. They're going to figure out a way. And so what they've done is they've figured out a way, and they've figured out there are very, very large pools of capital out there. And they said, why do I even need to go through a bank? I'm just going to go to these large pools of capital. They can be sovereign wealth funds, or they can be at managers or whatever. And I'm going to ask them to loan me the money directly. And I don't have to deal with the reporting. I don't have to deal with the bank. I don't have to deal with all these issues. And so what's happened is people talk about democratization. There's been a huge democratization for companies who either are trying to buy other companies or mid-sized companies trying to borrow money in terms of being able to access all these other sources of capital that weren't available 20 years ago. And so for me as an investor, what I now have the opportunity to do is to give my money or give money for some of the institutions where I sit on the investment committee to a manager and saying, why don't you go loan it? And that's what we call private credit or private debt.
Who is private credit suitable for? And what does it offer me?
The big difference are floating interest rates. Is a lot of this is done with floating interest rates. So when I borrow in the public debt markets, if I'm a big company and I go out and I issue debt, it will have a coupon, maybe 6%, 7%, what have you. In private capital, most of them use floating rate coupons. So if interest rates go up, you get a higher interest rate. If interest rates go down, you get a smaller interest rate. And so they tend not to have that interest rate risk. And that's why people like it, because they're not making such a big guess as to where rates are going.
Which types of alternative investments do you think are appropriate for the average individual for their retirement plan, for a 401k plan, for instance? Where should we look as individuals?
I think you want to be in an appropriately regulated and structured to know that there's some oversight over what's going on. You want to look for somebody who is also very experienced. You want to spread your money across a lot of different places because you want to get that benefit from not being perfectly correlated. So, I'd probably put, 5%, maybe in private equity and then another 3, 4, 5% in private credit and maybe the same in hedge funds, and just say that this is 15%. I still have 85% of my portfolio in very liquid assets, but this is 15%. It's going to perform differently. Some years it's not going to look great. Some years it's going to look wonderful. It's going to be different. But the way you get the best long-term returns is by being diversified.
Most individual investors have no clue as to, how to actually figure out, who's the best, who should I be investing with?
As a personal investor, I would probably be looking for a top quality private manager whose products are now being offered through a top quality distribution player who has access to a lot of portfolio managers. They're going to understand how the securities work. They're going to understand things. I like to think about the investment decisions are being done by the alternatives expert, but then the design and how you offer these securities are being done by the client expert. And so when you put those two together, it makes a very nice situation. And the other benefit you get from that is that the client-focused firm has a fiduciary obligation to monitor the alternatives firm.
Very important point.
There's a myth out there, a very common myth, that alternatives are always better performing.
Yes.
And that's not true. They produce a better portfolio. That's very true. I mean, if you think about it, when I started in this industry, we had the stocks, bonds, cash model. And then starting 25, 30 years ago, we're going to start talking about the Yale model. And the big difference is the Yale model has alternatives. And so you get a better return. And that's why a lot of people, even big pension plans, now follow that Yale endowment model. You get a better long-term return, we think, over time. You never know for sure, but we think over time.
One investment for a long-term diversified portfolio. You've been talking big about diversification, so what should we all own some of in a long-term diversified portfolio?
I'm just going to be blunt. I'm biased because my career in that area is hedge funds. I've seen more mistakes from people who try to time the equity market. And hedge funds are never going to be up as much as the stock market, but over the long term, they're never going to be down. And particularly if you are worried about valuation levels in today's market, I would invest in hedge funds rather than pulling your money out of the market.
Jane Buchan, it is so great to have you on WealthTrack. Thank you so much for joining us.
Thank you, Consuelo.
At the close of every WealthTrack, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point taps the experience of our guest, Jane Buchan. We asked her to share the best piece of investment advice she has ever received. This week's action point is be diversified.
The best investment advice I've ever received is to be very diversified. that the big mistakes are when people put too much in one asset. They think they know everything, and then it turns bad. And you've seen that when you hear and read about big disasters. At the crux of it, it's almost always the same thing. People think they have a sure thing. They think they can time the market. I want to be very diversified. Long-term returns. Long-term returns.
Given Buchan's expertise and history in alternative investments, it is not surprising that she is pro-diversification and focused on long-term investing. Both are key characteristics of alternative investments. Next week, we will have a rare interview with legendary Canadian investor Francois Rochon. He will take us through his focused portfolio of high-quality stocks at Giverny Capital. Please follow us on Facebook, X, and our YouTube channel. Thank you for spending your precious time with us. Have a super weekend and make the week ahead a healthy, profitable, and productive one.